We start in Israel, where the economy shrank 19.4% in the final 3 months of 2023 as the war has started to take a serious toll. This is the first time we've actually seen the economy shrinking in nearly 2 years. In the July to September quarter last year, GDP actually grew 1.8%. The worse than expected decline was driven by a 26.9% drop in private consumption as confidence plummeted following the October 7th attacks and households cut back on spending. Fixed investments by businesses also tumbled 67.8%. And this is as there was a halt in residential building with military call-ups and a serious reduction in Palestinian workers. On the currency front, the Israeli shekel weakened slightly after the data released trade at around 3.62 to the US dollar. It had staged a remarkable recovery since falling in the immediate aftermath of the October attacks, thanks to support from the central bank. The stock market doesn't seem to be impacted for now. We see the Tel Aviv 125 index gaining 0.6% on Monday. Nevertheless, the conflict is expected to cost Israel $70.3 billion by the end of 2025. That's equivalent to around 13% of GDP, according to the Bank of Israel. Let's get more on this now with Josh Mahoney. He is Chief Market Analyst at Scope Markets. Thank you for being with us. Josh, this is the first time we see negative numbers on the Israeli economy, and not by surprise. I mean, it really seems like there was no lag in showing for now. Is this mainly driven by a sudden cut in public spending and by the government, obviously, in the last 3 months of 2023, or are there other factors as well?
Well, firstly, what's worth pointing out is that we saw a 5.2% decline in Q4. And so whilst everyone's looking at this annualized number, which essentially is a case of taking that fourth quarter reading and saying, how would that look if it continued for an entire year? We haven't actually seen that decline that's around, the number is 19.4% annualized, but 5.2% contraction in Q4, of course, is a massive decline and really does point towards a significant shift for the Israeli economy away from consumption and more towards reservists being taken out of their jobs and being placed into the army, spending being placed more towards the war and less so towards economic growth. As you alluded to, we've seen a big sharp decline in terms of consumption, and that's likely to continue as long as the war goes on because of the fact that we have got so many people taken out of the workplace. We've seen a big slump in terms of spending by businesses and investments, and we've seen big export in terms of decline in terms of exports. That's down 18.3%. So really, I feel like it's a combination of both taking such a significant amount of workers out of the workforce, and we've also seen it in terms of restrictions on Palestinian workers, so labor shortages, and also a reallocation of resources away from the government spending on the people and more towards the war.
Precisely because of that. I mean, how long is this expected to last for the Israeli economy? Because we saw, as you said, serious labor shortages because of the military call-ups, but also Moody's has delivered Israel's first ever credit rating downgrade, citing elevated political risk. Give us a sense of how long it will take for the Israeli economy to recover, even after the end of or a hypothetical end of this conflict.
Yes, well, we have seen that downgrade from Moody's, Benjamin Netanyahu saying that he essentially thinks that this is just a vote against the war and saying that as soon as the war finishes, the economy is going to bounce back and be exactly where it was before. Time will tell. I mean, there is certainly a shift in terms of sentiment away from people utilizing Israeli goods. But in terms of domestic consumption and domestic spending, you would expect that they would potentially get back to normal relatively swiftly as people get back into their positions. But quite frankly, I don't think it's necessarily going to be as simple as that. I don't think that the moment that they move out of the Gaza region that suddenly the economy is going to be exactly how it was before. But no doubt right now we're at a pretty extraordinary sort of position, and therefore this is probably the height of what it's going to look like over the course of the war.
Very interesting insights. Josh Mahoney, thank you very much.
Thank you.
And now let's take a quick look at some of the other top stories from around the world. China has announced a reduction in its benchmark lending rate, a strategic move aimed at stimulating its faltering economy. This decision reflects the government's efforts to counteract the economic challenges by making borrowing cheaper and encouraging investment and spending. The cut in the lending rate is expected to provide a much-needed boost to various sectors, potentially leading to a recovery in economic growth. Capital One Financial has announced its acquisition of Discover Financial Services for $35 billion, uniting two major U.S. credit card firms. The all-stock deal values Discover shares at nearly $140 each, a substantial premium over their recent closing price. This merger is poised to significantly impact the payments industry, challenging the dominance of Visa and MasterCard. Mining company BHP Group has taken an $8.6 billion hit to its half-year profit after a $2.5 billion write-down of its nickel operations in Australia. The write-down was prompted after an oversupply in the nickel market forced BHP to revise the value of its nickel assets. Underlying profits, however, were still slightly higher than expectations, buoyed by strong iron ore prices and cooling inflationary impacts. Bayer has announced plans to slash its dividend by 95%. That's as the pharmaceutical giant ramps up its efforts to bring down its debt 8 years after its acquisition of US biotechnology company Monsanto. The German conglomerate warned on Monday that it would pay a dividend of just 11 cents per share for 2023, as it was the minimum level required by German law. Bayer paid a dividend of €2.59 in 2022.